All right, we are in the last quarter of 2019. We've just started the month of October, and I don't know about you, but I found that this year passed by in a flash. Is it me, or when you get older, does time pass even faster? Anyway, seems like just yesterday was the beginning of the year, and now in the last quarter. So here I am with another stock market analysis and looking at the markets on are we more bullish, are we more bearish, and what are some of the great opportunities out there for us to make some money on. So before that, let's take a look at where the markets come from. So since the beginning of the year, 2019 to October, the first week, the S&P 500 is up 17.76% in terms of capital gain. And that's pretty good because historically, the S&P 500 on an annual basis gains about 8 to 9% a year. So this year, we're up almost double the normal years. So it's been a pretty good year so far. So you can see that even if you did not know how to pick stocks and you were a complete idiot about the stock market, all you did was buy the S&P 500 ETF, you'd be up about 18%, almost 18% for the year so far. All right. So I tell most people, if you don't know how to pick stocks, just buy the ETF because you will definitely make money. Some years more, some years less, but you always make money over time. And again, this year you'd be up almost 18%. But the sad thing I noticed is that most retail investors out there would not have gotten, close to 18% return on their investment. Some of them even lost money. Some of them didn't make money. So why is that the case? Why is it that the stock market can keep going up, but people don't make money? And the reason is because people are affected by the mainstream news. I've mentioned this before in my previous videos. If you watch the mainstream news, you get so freaked out by people's opinions and predictions that you will not get into the market, right? So in fact, let's take a look at some of the mainstream news articles over the last year. In fact, beginning of December of last year before 2019 began. And if you take a look, this was back on December 24th, 2018, right, which was last year. And on CNBC, you see this headline that says, "The worst is yet to come. Experts say that a global bear market is just getting started." Oh my God, if you read this, what would you have done in 2018 December? You have sold everything, right? Or shorted the market and you get screwed because the market went up 18% after this article came out. So you never want to read these articles because they mess with your mind, right? And what's the next article that came out? The next one was January 2019, beginning of the year. And again, another website, again, I'm not just blaming CNBC, they are all like that. It says 2019 stock market crash, 70% correction warning. And they give you all the warning signs, there's 70% chance going to have a crash. Yeah, right, it's up 18%, dude. All right, and then in March of 2019, we have again Mr. Stockman. How can we forget Mr. Stockman? Every few years, Mr. Stockman will come out and say the market will crash. All right, this year's no exception, right? And how can, again, you not listen to someone called Stockman? He was born to talk about stocks. And Mr. Stockman said 40% market plunge is inevitable. Crap. If you read that, you'd be out of the markets, right? And again, this was August 2019, 2 months ago. 3 charts suggest the stock sell-off could get worse. So notice what happens to most retail investors, right? They read all this bad news, they sell the stock, and the moment they sell their stock, guess what? Stock market goes up and they get screwed, right? So remember, never base your investment decisions or trading decisions based on listening to the opinions of other people or reading all this news. We call it market noise, right? Your investment and trading decisions must solely be based on fundamental analysis, analyzing the fundamentals of the individual companies. Are they undervalued or are they overvalued, right? And looking at the technical patterns of the markets and the stocks and the sectors. Is it on an uptrend? Is it on a downtrend? Are they at support levels? Are they at resistance levels? Look at Fibonacci ratios. All these things are things that tell us where the market is right now. Remember, no one can predict the future. No one's a fortune teller. I can't predict, where the market's going to be a year from now, 6 months from now, 1 day from now, right? But what I can do is I can read the fundamentals of the company. If they're undervalued, I know that it's going to go up eventually. If it's overvalued, it's going to come down eventually, right? I buy when it's undervalued. I get out when it's overvalued. I look at technical analysis. I can tell right now, are we on an uptrend or on a downtrend. On an uptrend, I stay long because on an uptrend, probability is that prices will go higher because the market always moves with the trend in terms of probabilities, right? I enter at support level. So as long as you follow the fundamental and technical rules, you will always beat the market consistently. So again, the market's up about close to 18% return. And again, if you're just an idiot, you just buy the ETF, you get 17, 18%. But if you put in some effort to pick some good companies like what I do and my students do, you should get a lot more than that, right? So let's see, right now, let me just check my portfolio. This is one of my portfolios. So yeah, right now, year to date, I'm up about 31.9% or 32, roughly about 32%. I was up middle of the year about 40%, but because of the slight correction in the market, it's about 32% now. Hopefully, if the market continues rallying to the end of the year, which I think it should, then I could end off the year with about 40% return for the year. Hopefully, we'll see how it goes. Again, I can't predict the future, right? So again, the green line that you see over here, that's my portfolio. And the blue line that you see is the S&P 500. So I mentioned before that as an investor, our aim is to always be able to beat the S&P 500 every single year. Because if you can't beat the S&P, you might as well not pick stocks and just buy the S&P ETF, close your eyes and get average of 8 to 9% every year, right? But by picking stocks, you should be able to get, at least 20, 30, 40% a year. And that compounds to a huge amount of money to build your financial security over time. Okay, so where are we right now? All right, so the market's up, like I said, almost 18% for the year. We're in the last quarter. Where do I see the markets going for the end of the year and for next year? Now, again, let me just say that no one can predict the future. Everyone can give their opinions, but no one's a fortune teller. But what we can do is we can read the technicals of the chart to see what gives us the highest probability. Are we on an uptrend or are we on a downtrend? On an uptrend, probability is that prices will move higher unless we see a change in trend. So having said that, let's jump into the charts. So over here, I have got the S&P 500 index. And this is year to date. I'm looking at daily candles. So I like to analyze using daily candles, and I can go on to weekly and even monthly candles to get a bigger perspective, right? So we can see that we started here in January, and now we are here in October. So again, we're up about 17+% for the year, right? So very, very nice uptrend. And you can see again, on an uptrend, prices don't go up in a straight line. They go through normal corrections, right? So we call that a correction, there's a correction, there's a correction, and there's a correction, right? It's kind of like breathing. You can't breathe out forever. You can't breathe out, right? You gotta breathe out, breathe in, breathe out, breathe in, breathe out, breathe in, breathe out, breathe in, right? So every time the market breathes in, every time there's a correction, it's a buying opportunity. That's when you want to buy when it's breathing in, because that's when you get a good price before the breathing out. Trouble with most people is most people don't buy at the breathing in. Why? Because during this breathing in, the correction, you got all the bad news, right? Recession, and when people read all that bad news, what do they do? That's right, most people tend to sell, and they sell at the worst time when you should be buying, right? And most people tend to buy over here. They buy here, they buy here, they buy here. Why? Because that's when you got good news. That's when people say, hey, the economy is doing well, and they buy. Once they buy, bad news comes and they sell. So they always end up losing money. So to make money, you got to do the complete opposite of what the news tells you. You got to do the complete opposite of your emotions, right? To make money, what you got to do? That's right, you got to buy when there's bad news. Oh my God, you got a recession, buy, right? That's right. And if you want to, when there's good news, you could sell as well, right? Now, the question is always, how do we know when is the end of the correction? When's the end of the breathing in before it breathes out? So that's when we use moving averages, right? So you can put in all your moving averages. There we go. Okay, so now I go to, let's go back to the year-to-date time frame. Let's just remove the 100 for now. Don't want to confuse you too much. Okay, so notice that again on an uptrend, moving averages act as dynamic support levels. Every time the price comes down, you'll find support at one of the moving averages. So you see the price comes down, find support at the 150, right? Toing bounces off. Support at the 150, 150, 150, 150, right? So moving averages help us to determine when's a good time to get back in once it has hit the moving average, bounces off the moving average. That's when we buy, that's when we buy, that's when we buy. That's right. And I've taught this to you guys many times before. As long as the 50 moving average, the blue line, remains above the green line, and both lines are flat or sloping up, we've got an uptrend. That's right. Only when the 50 crosses below the 150, slopes down, then we could be on a bear market downtrend. That's when you don't want to buy anymore. That's when you want to get out of the market or buy put options to protect your portfolio. Okay, so we're not there yet. We're still on an uptrend. And again, you can also look at the 200 moving average, the red line. The 200 moving average is the granddaddy of moving averages. It's a long-term trend, right? So again, normally when the price is above the 200 sloping up, our long-term trend is intact. But when the price goes below the 200 and the 200 slopes down, that's when a bear market could start. That's when you want to get out. So for now, contrary to what a lot of people are saying, there's no bear market yet. We're still on an uptrend. We're still in a bull market. How long will it last? I've got no idea. I can't read the future, right? But as long as it's in a bull market, we're going to buy, we're going to stay long. Okay, there we go. Okay, so again, looking at charts, we are in a bull market, right? And right now, we just bounced off a very strong support of the 150. And so I started to take some new long positions, both in my short-term trading portfolio and my long-term investment portfolio over here. So based on the chart patterns, right? We should be heading higher to make new highs, all-time highs, newer highs by the end of the year. And again, that's based on the current trend. Again, it could change as it changes over time. See, as an investor or trader, you got to be flexible, right? You can't have a fixed mind. So although the charts tell me we're going up and I'm buying right now, but the moment I see it changing, it's reversing on a downtrend, I got to be flexible. I can't be stubborn to hold on. I got to get out of the market. That's right. So when that happens, I'll let you guys know. Or I'll buy put options to make money as the market collapses. So you got to be really nimble to get in on the market really fast in order to maximize your profits. Okay. Now, you can also use Fibonacci to kind of like help you to determine where the support levels are. Okay, so see in Fibonacci, every time it retraces and it meets a 38.2%, right? 38.2%, or a 50%, or a 61.8% level, that's a significant support level as well, right? So for example, if you take your Fibonacci tool over here, right? And if you have to identify, first of all, remember in Fibonacci, A, B, C. So A to B is the impulsive wave or the breathing out wave. So we breathe out, breathe in. So B to C is called the corrective wave. So when the corrective wave corrects, if it's a shallow correction, it's a 38.2%. It's of a medium correction, 50%. If it's a big correction, 61.8%. Okay, so that helps us to determine the levels. So if you take a look at the charts, it respects these levels, right? So if you take your Fibonacci and you go, okay, A, B, C. There we go. A, B, C, and C finds support exactly at the 61.8% level, right? So this is the strongest Fibonacci level. Very, very powerful, right? You can see that. So Fibonacci is very useful to confirm these levels. Okay. Now, you can even take this, right, from A to B. There we go. A, B, C. And C is at the, that's right, 38.2% level, right? So it's always at one of these levels. Very, very powerful, okay? So you can see that this was an ABC wave, right? ABC wave. And this was meant to make a higher high, but it never reached a higher high because of some, I think, tweet that came off Trump, the impeachment, right? Eating a peach, right? So it's come back down again, but finding support over here. Okay, but it is still part of this wave, right? So from this, we expect the next wave to go up based on the chart. So we'll see how it goes. So again, I'm still bullish on the market and I'm still long on the market. So this is based on a technical pattern. Now, I always believe that you have to combine technicals with fundamentals, right? They both have to sing the same song. So like I said, based on technicals, I'm bullish, right? We're on a clear uptrend, we're at a support level on an uptrend. But how about in terms of the fundamentals? What are the fundamentals that are driving the markets higher? Now, my students, my inner circle, if you enroll in one of my courses, you get my monthly analysis where I detail everything in detail. Okay, so this was my latest October analysis. I send this update on the 1st of every month, and I tell my students what I'm buying, what I'm selling, my portfolio, all my insights. So this report alone is worth to some people, hundreds of thousands of dollars a year. To some people, my big clients, they're worth millions of dollars. This report that I give them, and it's free in my inner circle, right? So let me read to you my report because I can't remember what I wrote, right? Okay, so over here, what did I say? Yeah, okay. That's right. So there are several reasons why I'm bullish on the markets. Why I'm still bullish, right? So I mentioned the first reason is because the technical trend remains intact. Number two, many sectors like big tech, Facebook, Amazon, Google, they are very undervalued right now. They're selling below their intrinsic value, okay? Healthcare is undervalued. Cyclicals like banks are undervalued. So there are many sectors that are still undervalued. So that tells me the market is going to go a lot higher, right? Next, I mentioned this in my last video, I believe, that the yield on the S&P 500, the dividend yield on S&P 500 stocks have crossed above the treasury bond yields, which means the government bond yields. See, normally, when you buy a government bond, it's safer, right? And government bonds should give you higher interest rates than the stock market dividend yields, right? Because it's safer. But right now, the S&P 500 companies, the dividend yield is higher than government bond yields. And that's very rare. That only happened after the Brexit declaration. When the market crashed, it happened and the market went up, right? And this happened right after right at the bottom of the financial crisis. So this has always been a bullish signal. Whenever S&P 500 dividend yields exceed treasury bond yields, it tells you the stock markets are undervalued relative to bond markets that are overvalued. And that normally signals a rotation back into stocks that sends the markets higher. Next, the Fed is now dovish, right? Which means that the Fed, from raising interest rates, they're now on an interest rate cutting cycle because the rest of the world are going negative interest rates. Next, if you look at US presidential cycles, right? Normally, the third and fourth term in the presidential year is the most bullish for the markets. And this is the third term for Trump. Next year is the fourth term for Trump, right? So the third and fourth term is normally the most bullish in terms of market cycles. Now, some people would say, but Adam, what about all this recession talk, right? Everyone be talking about recession is coming, recession is coming. So why is everyone saying a recession is coming? Because the yield curve, the down yield curve has inverted, right? Which means the long-term 10-year yields have gone below the 2-year treasury bond yields. And that has predicted a recession in the past. Now, I have to say one thing. The yields have inverted back, so they're no longer inverted, right? But remember, let me just show you my slides again. I mentioned this in my previous, let's see, where are my slides right now? I mentioned this in my previous video on the stock market crash, right? Where I was, making fun of all the people calling for stock market crash, because yeah, this was back in August, 2 months ago, right? And everyone was talking about recession, right? And market crash because the bond market flashed a recession warning, right? The yield curve inverted, right? I remember what I taught you in that video. Now again, if you forgot, go watch that video again, right? Go watch that video on Adam Khoo yield curve. Go to YouTube, type Adam Khoo yield curve, watch my video where I talked about the yield curve inversion. And remember that historically, when a yield curve inverts, yes, a recession will come. Well, not all the time, but at times. But even though it comes, remember one thing. Back in 2005, December, the yield curve inverted. But did recession come immediately? No. After the yield curve inverted, the stock market, the S&P, went up 25% in the next 23 months. So people who sold because of this signal would have missed 25% return on their portfolio in 23 months. And that's why I say never predict the market based on economic signals, because if economic signals make you a millionaire, all the economists in the world will be millionaires or billionaires, right? All the professors of economics will be billionaires, but they're not. In fact, most of them, they don't make much money in the stock markets. People who make money in the stock markets, they don't listen to economic news. They follow the technical trend. So did the market eventually top? Did we eventually have a crash? Yes, but it happened 2 years later. So you would have missed out 2 years on gains fearing something that came 2 years later. So how would we have known to get out here, right, before the crash in 2007? Again, I keep telling my students, simply look at the moving averages, right? There we go. So like I keep mentioning, the moment the 50 moving average, the blue line, crosses below the green line, which is there, you sell, get out of the market, or buy put options, get out before the crash. That's right. Now, how about this? Was this a sell signal? Yes, this was a sell signal as well. So if you bought somewhere there, you would have sold there, correct? And you would still have made some money. And once the 50 crossed back above the 150, you get back in again and you have made this profit, right? So yes, at times you would get a false signal, but no worries, you get out, get back in again, right? And once you get out, you would save yourself from a 50% crash. Now, will this happen eventually? Of course it will. When will it happen? I've got no clue. 1 year from now, 2 years from now, 5 years from now, maybe 10 years from now. No one knows, but don't predict the future. Just follow the trend. Simple as that. Now, if you take a look at valuation, are markets overvalued or markets undervalued? Now, if you take a look at the S&P 500, the PE ratio. Remember, PE ratio stands for price divided by earnings. So PE ratio tells us, are we on the top or the bottom of the market cycle? Okay. So at the top of the market cycle, prices are very high, right? Stock prices are very high relative to earnings. So PE is very high when the market's at the top. When the market's at the bottom, usually after a crash, prices are very low relative to earnings. So PE is very low. Got that? So when PE is high, we're at the top. Be careful. When PE is low, we're at the bottom. Time to buy. So what's high, what's low? Right? So we look at history. So based on the last 85 years, it's longer than I was born. Based on the last 85 years, you can see that the median PE is 15. And the lowest PE is about 5. And the high is somewhere about there, about 25 to 30. So what it tells you is that when the PE ratio is 25 to 30, be very careful. We are in bubble territory, right? We're at the top, we're gonna go down eventually, right? At 5, you buy like crazy because the market's bottom, right? At 15, we are fairly valued. So where are we right now? Now, if you go to Bloomberg and you check Bloomberg, right now the P ratio of the S&P is about 19, right? 19. So we're somewhere about there right now. So what does it mean at 19? It means that we're not cheap. The stock market is not cheap. I've been saying that for years. It is not cheap, but neither is it very expensive. It is slightly above 15, so it's slightly expensive, the stock market. But again, having said that, like I mentioned, overall the stock market is a bit expensive, but there are sectors, there are areas which are cheap, like banks, like health insurance companies, like big tech companies, and I'll be talking about that in a short while, so hang on to it for my next part of this lesson. So if you want to be the first to get my next video on YouTube, do click the subscribe button right now. If you want to check out my online courses, go on to piranhaprofits.com, where you can enroll in our professional Forex, stock trading, options trading, and value momentum investing courses, where you're going to learn how to trade like a professional and generate an income anywhere in the world. If you would like to come to Singapore to attend my live classes, Wealth Academy, go on to wealthacademyglobal.com. It's Adam Khoo, and may the markets be with you.